The founder of FTX is Sam Bankman Fried. He's a former MIT graduate that went on to work at a New York-based trading firm called Jain Street. While working there, he discovered an arbitrage opportunity in Bitcoin. It basically means that the same asset was trading at a different price on two different markets. The Bitcoin price was higher in the United States than it was in Japan. He traded as much as $25 million per day to take advantage of the opportunity. In 2017, Bankman Fried used the money that he made from Bitcoin trading to start a company called Alameda Research. The company mostly consisted of friends from MIT and former work associates from Jain Street. Alameda ended up playing a critical role in the crash of FTX. I'll come back to that later. In 2019, Bankman Fried started FTX. FTX is a cryptocurrency derivatives exchange. It's like a stock exchange, except that it's made for trading crypto assets. It's important to note that FTX also created its own cryptocurrency that traded under the symbol FTT. Bankman Fried created FTX after noticing that most crypto platforms were just servicing inexperienced retail investors. He saw an opportunity to create a competitor that offered more advanced financial products, like futures and options trading for crypto and tokenized stocks that could track the value of shares in companies like Tesla. The investment community liked the idea, and Bankman Fried managed to raise $2 billion from multiple investment banks and hedge funds, including BlackRock. In 2021, there were reports indicating that FTX was averaging $10 billion of trading volume per day from approximately 1 million users. In the meantime, as all of this was happening, FTX didn't even have a real board of directors. The FTX marketing machine was also peaking. FTX acquired the naming rights to a stadium in Berkeley and another stadium in Miami. They set up an advertising partnership with the Golden State Warriors and the Mercedes Formula One team. Multiple celebrities started endorsing FTX, including Tom Brady, Steph Curry, Naomi Osaka, and Larry David. A report from NBC mentioned that the celebrities also received equity in FTX, and some have reported that Tom Brady might have invested his entire $650 million fortune into FTX. At this time, Sam Bankman Fried's net worth was estimated to be $26 billion. He donated $5 million to Joe Biden in 2020 and $50 million to Democratic politicians running in the 2022 midterm elections. A lesser-known player in FTX donated $23 million to Republican politicians. So people working in FTX were donating to both sides of politics. Political donations are the main driver of all political corruption, and it's one of the main reasons that direct democracy is better than representative democracy. If you want to learn more about direct democracy, check out the other videos on my channel and the links in the description. In the meantime, Alameda Research had transformed into a business that operated like a crypto hedge fund. They managed money on behalf of crypto investors. One of the promotional documents from 2019 convinced a lot of people to invest by promising a 15% annualized fixed rate return. 15% returns are common. They happen all the time, so that's not a problem. But there's no way to promise or guarantee that it will happen. That part is a problem. Over time, Alameda received $10 billion in FTX customer funds. There's nothing wrong with money flowing into FTX because it's an exchange. That's what's supposed to happen. But none of that money should be going from FTX to Alameda because that money belongs to the customers that deposited those funds into FTX. This is a clear violation of multiple rules and laws. In the meantime, the US Federal Reserve started raising interest rates in an attempt to fight inflation. When interest rates move higher, it means that investors can achieve a better rate of return on riskless assets like treasury bonds. So that means that funds will flow out of assets that do have risk, like stocks and crypto, and into riskless assets, like bonds. This is why you often hear the expression risk on and risk off. Of course, the higher the perceived risk of an asset, the bigger the downside. A lot of crypto assets started falling off a cliff, and Alameda Research saw an opportunity. They could buy them at very low prices and achieve two objectives: bail them out and make a huge profit when they recovered. But the crypto collapse was still unfolding, so instead of making a profit on these trades, they made a loss. One example was the loan that FTX provided to Voyager.
We've talked about has emerged to help stabilize the ecosystem. That is Sam Bankman Fried, founder and CEO of crypto exchange FTX. Bankman Fried's company provided a loan made up of crypto and cash. It was worth about $500 million. Voyager only drew on about $75 million worth of that total. Legal analysts, though, are telling me it's unlikely Alameda will recoup that equity and credit line. That money may be wiped out in Voyager's restructuring.
In order to cover losses from these failed trades, Bankman Fried transferred $4 billion of FTX customer funds to Alameda. Of course, this was all visible in FTX wallets, so he tried to make sure that people weren't alarmed by sending out a tweet to reassure them that nothing bad was happening. It's important to note that the $4 billion that was transferred was not cash. It was $4 billion worth of FTX's own token, FTT. Of course, this plan could only work if FTT maintained its value, but it didn't. While all of this was unfolding, one person was watching more closely than most. His name is Changpeng Zhao, or CZ, is the founder of Binance, the largest crypto exchange in the world. Sam and CZ knew each other. 6 months after launching FTX, CZ bought 20% of FTX for approximately $100 million. Bankman Fried later decided to buy back that FTX stock for $2 billion, but it wasn't paid in cash. It was paid in FTX's token, FTT. Over time, FTX grew into a significant competitor, and the two founders had different views about how the industry should evolve and operate. Now that FTX was struggling, CZ saw an opportunity to take down a competitor. He owned $2 billion worth of FTT, so he knew that he could crush the FTT price by dumping his stake into the market.
November 6th, when Binance said it would offload hundreds of millions of dollars of FTT.
The price of FTT collapsed by 80% over the next 2 days. People were getting nervous about FTX and started withdrawing their funds from the exchange. But FTX had already transferred billions of its own reserves to Alameda and didn't have sufficient reserves to cover the withdrawal requests from customers. They had $9 billion of liabilities and $900 million in liquid assets. If you don't understand the accounting in the financial world, customer funds have to be listed as a liability on your balance sheet because it's money that you have in your possession but you owe to the customer. The $9 billion of liabilities was money owed to customers. Bankman Fried knew his empire was about to collapse, so he called CZ and negotiated a deal to sell FTX to Binance. Binance is a whole other story. The US Justice Department is investigating allegations that they've been involved with money laundering. There were reports that Binance helped Iranian firms trade $8 billion since 2018 despite US sanctions. Of course, Binance is not an American company, so it has the ability to tell the US to go f*** itself. Not long after Binance announced that they would buy FTX, they made an announcement saying that they were not going to go ahead with the deal. Binance say that they discovered a bigger gap between assets and liabilities than they were expecting, so they killed the deal.
Why don't you take us back, if you could, to when you first got the call from Sam and you first had a chance to look at the books, because I think a lot of people are still trying to understand exactly what happened here. How much of this was about commingling? How much of this was about terrible marking of the books? What did you see?
Yeah, I think I got a call from Sam 48 hours after I made the tweet, and then he wanted to talk. So at the beginning, I thought he would just wanted to, do a buyout on, do an OTC deal to buy out the FTT tokens we had, and then he wanted actually a buyout of the entire firm, of the entire FTX platform. And then, but then we got our team on, and it was pretty clear pretty soon that there's, there's misappropriation of user funds. The user funds are gone. At that point, it's clearly that he lied to his users, his investors, his VC investors, his employees. At that point, I thought I couldn't, whatever data that's in the data room, we couldn't trust anymore. So it was quite hard for us to do that due diligence. So we didn't go very far.
On November 11, Sam Bankman Fried resigned and sent out a tweet stating that FTX and Alameda are filing for bankruptcy.
Over $150 billion. In 3 days, that's how much the world's 15 largest cryptocurrencies lost in market value. It's because of the crypto exchange platform FTX, which is behind this token, named FTT. On November 6th, the token's value began to fall, losing more than 80% of its worth in the span of 72 hours.
It triggered a crash in the crypto markets that wiped out $150 billion of value in 3 days. The first question that we should be asking is whether FTX failed as a result of an inability to execute a business plan, or whether it failed due to illegal or unethical business practices. It didn't take long for reports to surface about $1 billion worth of customers' cryptocurrency vanishing from FTX. Blockchain detectives are obviously trying to figure it out, but there's no more news as at the time of this video. The FTX bankruptcy involved 134 affiliated companies across the world and total liabilities that could be as high as $50 billion. If you want some context, Enron's liabilities were $23 billion. The reason I mention Enron is because FTX's new CEO in bankruptcy is the former Enron bankruptcy lawyer. Okay, so what went wrong and how do we stop it from happening again? When FTX's customers started withdrawing their funds, FTX didn't have enough cash to give everybody their money back. It's important to understand that this scenario is the equivalent of a run on a bank. This is what happened back in 2008, and this is why Congress passed a bill to bail out the banking industry. Why am I bringing this up? Because I see a lot of people saying that FTX collapsed because there was no regulation. You need to remember that every US bank does not have sufficient cash reserves to cover customer withdrawals. If everybody wanted to withdraw their funds from a major US bank at the same time, the bank would collapse. If FTX was regulated like a US bank, it would still have collapsed. I'm not saying that crypto exchanges should not be regulated. They should be regulated. But I'm also saying that it won't solve all problems. In the meantime, it's important to understand that crypto investors generally fall into two categories. One category consists of people looking to make a quick buck by watching stupid YouTube videos made by people that provide crypto price predictions without having any understanding of financial markets or crypto technology. Even though these investors are clueless, and they really are clueless, they still play an important role in the development of crypto because they contribute trading volume, and that makes markets more efficient and it makes price discovery more reliable. The other category consists of people that value the ability of crypto to democratize the entire financial industry and many other industries, as well as decentralizing the financial world so governments cannot exert so much financial control over us. Every year that goes by, the governments of every developed country incrementally increase the level of control they have over us. This is obviously a massive issue that can be completely addressed with direct democracy. Crypto will play a smaller role, but it's still an important role. So what needs to be done? 1. Governments need to regulate crypto exchanges. 2. Crypto developers need to continue working on creating crypto trading platforms that operate with trustless trading mechanisms that won't allow any interference by individuals or governments.